I'm talking today about costing and pricing, following on from Paul's presentation about outcomes. And I just wanted to put it in the context of what Paul was talking about, where we're moving from an accountability from agreeing to do certain activities and incurring various costs to do those activities to now being accountable for delivering outcomes. So the accountability has moved from activities and cost to activities and outcomes. Under the previous model, organisations that tendered for funding to deliver services used to have to talk about those activities and explain what costs will be incurred, almost line by line, saying these are the wages costs, these are the program costs, these are the admin costs, etc. Under the new model, that breakup is no longer required. What is required is to deliver a price. So I'll be talking about three things today. First one, just the context of outcomes and how it relates to prices and cost. Secondly, how do you establish the full costs that are incurred in delivering those services, which is then a step towards establishing what price you're going to charge. So it's a different function. There's the costing function and the pricing function. So I'm starting with the costs, and I want to be talking about, first of all, the policy objectives of working in partnership, establishing each organisation as a sustainable organisation that will survive in the long term and continue to develop and grow, and being properly funded to do that. Also, a context is that of innovation. There's a real desire that organisations, community service organisations, work collaboratively with government to develop programs that are going to be innovative and deliver these outcomes. And of course, reducing admin burden and having a outcomes-based accountability. So the types of costs I'll be talking about are sort of three different headings. The first one being the actual costs that you'll have in your general ledger now, the costs that we all know about. The second set of costs will be future costs that you may incur now but won't pay until a future time, but you need to build the provision to pay those costs when and if they do occur while you're receiving income. So I'll talk more about that. And thirdly, what I might term notional costs. And that's the value of things that you might get now as a community service organisation that you don't pay for. Now that will be things like volunteers and the like, and I'll again talk about that when I talk about that. The reason I want to talk about those three things is part of this outcomes-based contracting and tendering revolves around putting your best case forward. Paul talked about your value proposition, and that value proposition will be in terms of the outcomes you deliver because you've got a really good service model that's going to help deliver those outcomes. And secondly, that you're doing it in a cost-efficient way, and the price that you're offering is an efficient price and a good price, and it's got values in there that won't be reflected in your normal cost because you don't pay for them. Does that make sense? I hope so. So just going back to the first set of costs, I'm going to talk about those which are in your general ledger. And obviously wages, selling wages in this sector is usually the main cost. And usually in the range of between 60 and 80% of costs are selling wages, therefore it's a really good idea to understand them. And I want to talk now about salary on costs. Now it's a term you may have heard of, but it relates to the additional costs that are incurred when you employ someone. So, for example, if you employ someone and pay them an annual salary of $55,000, it's going to cost you more than that to employ them. Even though they only get paid that much, there's an additional cost attached to that. And the first area is all the leave provisions that will be incurred. So generally people get, if it's a full-time employee under a normal arrangement, it's 4 weeks annual leave. Sometimes there's leave loading of around 17.5% for that 4 weeks. Usually there's a long service leave accrual, and that varies, but 13 years after 13 weeks after 10 years is a common one, common accrual. Usually people are entitled to 2 weeks sick leave, and that's cumulative, so usually it's cumulative, so that up to 2 weeks of every year people may be sick. Now, that's also extended to compassionate leave and family leave and other things, so the likelihood now is greater that people will actually utilise that leave because it can be applied to other members of the family. There's also 2 weeks of public holidays and other leave like parental leave and study leave and those sorts of things. It's also important to know whether or not you have to replace people while they're on leave, because that will determine perhaps an additional cost. So that if you do have to replace someone when they're away, either through having additional staff complement to do it or to get someone else in, you need to think about that as well. Now, if you add that up, annual leave is 4 weeks. Long service leave is around about a week a year, just under. Sick leave up to 2 weeks a year. Public holidays 2 weeks a year. Parental leave depends, but I think it's up to 6 months depending on the arrangements. And compassionate leave and other leave entitlements, whatever. That adds up to around about 10 weeks leave. So 10 weeks over a 50-week year, 52-week year is around about 20%. So about 20% of your cost of employing someone needs to be added on for all the leave entitlements they're entitled to. There are other on-costs also. You need to pay workers' comp, and generally the amount for workers' comp is between 2 and 5%, and 3.5% seems to be a figure that's often used in this sector. Superannuation is 9% of salary, and that's going to 12% over the next 6 years. So that, and then there's other time off for training, development and the like. So if super's around up to going to be 12%, workers' comp's 3%, and it's 20% for your leave loading, you're looking between 30 and 35% for on costs. So it's understanding that when you employ someone, say for $50,000, it's going to cost you $65,000. And you need to build those costs into your proposals to work out the full cost of delivering the service. Now, you might subsequently make a decision that most people don't use their sick leave entitlement fully, and you might want to reduce your price because that's what you think happens. But you do need to be careful, because even if your experience has been that people don't use all their sick leave entitlement, they stay with your organisation for 7 or 8 years, they might accrue 10 weeks leave. They might then get really crook or have an accident and take all that time off at a future time. So if you're not making provision now, and I know that you don't normally put sick leave into your balance sheet as a provision, but you do need to consider it in working out what your costs will be in delivering these services. Okay, now next thing I want to talk about is the concept of unit costs. What I've talked about in salary and wages is really the global amount of how much you pay for your budget or your contract for your total salary cost. But there are times when you're going to deliver a service and get paid by the unit. So it might be a counselling service that you're offering. Say, an example I use is if you're providing a counselling service to prisoners before they're released, with the intention of assisting them move into life subsequent to being in prison. You may be paid on a per unit basis of 5 hours per day counselling service. So you might go visit a prison and spend 5 hours counselling a prisoner or a couple of prisoners. So how do you work out the cost of that? It may be that obviously, and if they're paid $50,000, that's $25 an hour. So in working out the cost to do that service, obviously there's 5 hours spent at $25 wages, which is $125. However, you also need to think out the preparation time. There might be 2 hours spent reading up notes beforehand. There might be an hour's travel there and an hour's travel back. There might be a requirement to write it all up at the end of the day for administration type purposes. There might be days when you go there and there's no one to counsel, so you might not get paid for those days, so you have to factor in some sort of cancellation margin, and your counsellor might need professional supervision. So to in fact deliver that 5 hours of counselling, you might be spending, say, 10 hours or 15 hours, but say 10 hours. So rather than being 5 hours at $25, it's 10 hours at $25, but then you have to mark up that labour cost to include on costs. So it might be 10 hours at $35. So it's $350 for that 5 hour session rather than $125. And that's just the labour component. On top of that, you have to build in your program costs, whatever they might be, the additional things you need to spend to do it, maybe mobile phones or computers or whatever. And the next thing you need to think about is overheads. Overheads is probably one of the least well understood and least well managed costs that are incurred. And the terminology is really important because often it's not well understood. And often funders seek further clarification of what's in your overheads. So you do need to have a pretty robust methodology. There is a risk in having a general overhead rate that you may well be under-allocating or over-allocating overheads, which means you're either underpricing a service or overpricing a service. And both those situations have got adverse consequences. If you're under-costing a service, it's more like the more you do, the quicker you go broke, and you're not recovering your full costs. If you overcost a service, you lose your market competitiveness, and it's just not viable for people to pay for your service. And it's important to understand the different types of, the terminology around the different types of overheads. There's what's called a fixed overhead, and they're variable overhead. An example to describe the difference will be if you have a head office and it's got rent for that office, say, that's a fixed overhead and that's not going to change whatever. You might decide to open a new branch or a new service somewhere and you have to rent another office for that. The rent for that additional office is a variable overhead because it's directly related to that service. So you need to be able to differentiate between what's a fixed overhead and variable overhead and make sure that your methodology is very robust. The other thing about overheads is that they can fluctuate for reasons outside of the service you're offering. In that if you have a fixed overhead for, say, a head office rental and you've got 2 branch offices over which you allocate that rent, if you open a 3rd branch office, then that fixed overhead is over a larger amount, therefore the cost goes down. So effectively, if you're putting in a proposal for a 3-year contract with a price, you have to be aware that those costs might change over the term of that contract. Now, if you have more services to spread that overhead across, that's good, and in fact your profitability will improve because you're recovering that cost over more. However, the downside is if you go from 3, say, to 2 external offices and you've got less to spread it over, your costs go up, and that can be quite significant, particularly if the basis on which the allocation is not well thought through. So it may be that you work out a price now based on a certain level of activity across the organisation. Now, if that changes over the term of your contract, you need to be prepared for the impact of that change and build that margin, that sort of thinking into developing your price. But I'll talk about that a bit more. Okay, so that's, and obviously there's other program costs which are in your general ledger which you probably all know about, but it's really important that, if anything, they're well coded so that the right costs are allocated to the right areas so you know what different services are costing you. Now, I want to talk now a little bit about what you might call future costs. And they're costs that you might incur in the future as a result of what you're doing now. And a common one and an obvious one is potentially redundancy payments or severance payments. So if you have a contract or a level of activity and you employ staff on a full-time basis, and then for whatever reason that contract's not renewed or you can decide not to continue that program, there may well be redundancy payment obligations to be made. If that's a possibility, you need to be thinking about that and working out your costs, because it is a real cost, even though you may not pay it during the term of the contract or the term of employment, and in fact you may never have to pay it if people, and there's no need to make redundancy. Hopefully that's the case, but there is still a possibility. So it's important to understand what that future contingency might be. Also with accommodation, if you rent a property and you just no longer need it, quite often there's a make good provision so that you have to return that office to the site beforehand. There may be a breaking a lease cost, or if you own the property, there might be a future maintenance cost and refurbishment cost, which you need to build into your cost now because that will be required then. There's also insurance implications. If you currently have indemnity insurance, there may well be a need to continue to have that indemnity insurance beyond delivering that service, because there's still a statute of limitations of 7 years. So potentially anyone that wants to bring action against you has got that period of time to do so. So you will need insurance. Now that may be covered in your current policy, but it may be that you need to continue to have an insurance policy when you stop delivering the service. And finally, often when you close a service, there's a chance that there's going to be reputational risk. For example, anyone that's been involved in closing a hospital, there's often large community dissatisfaction about a service disappearing. Now, if you're going to continue doing other services, it's important you manage any public relations or reputational issues around finishing a service or closing a service, explaining why you've done it and the like. And again, once it's closed, obviously the money stops. So throughout the term of your contract or income, you need to make some sort of provision for the event that you may need to close a service. So that's not to say that those things will always occur, and it's also not a fully inclusive list. There may be other things you need to think about, but just be thinking ahead to future costs or costs that may result of what you're doing now at a future time when the revenue dries up. Does that make sense? Okay, the third area is what I said, notional costs. And again, it's really important that you present your value proposition to your funders to explain the value of what you're offering. And being the charitable sector, you have access to some things that the for-profit sector doesn't always have access to. And one of them is volunteers. Quite often people are happy and prepared and actually want to offer their time and effort to assist you in doing what you're doing. Generally that's not replacing what would normally be a paid position, but it may be that the net effect of all those volunteers is if they weren't there, then you would have to employ someone or people to assist to do what they are currently doing. Equally, quite often not-for-profit organisations get discount rent or no rent at all. They have a very benevolent landlord, or they get support from agencies like lotteries to occupy premises at below market rate. Again, it's important to know what the value of the service you are providing has to include the value of those sort of concessions. It's not to say you're going to include in your price, but you need to know what the value of what you're offering, so that when you offer your contract for consideration, the value of that is included. There's also concessions. Quite often not-for-profits provide services at a discount rate because often the people that attend those sessions can't afford to pay. And sometimes that gets lost in the mechanics somewhere. So working out how much the value of the service you're providing when normally there's a fee for service, or if you have a discount fee for the service, or if you just agree to let people in if they can't afford to pay, knowing the value of that's really important. And finally, there's a finance charge, a value of capital tied up in business. You know, most often it's the value of the building that you occupy. There are other funds invested in business, working capital alike, but primarily it's the building, the value of the building. So if you own a building that's worth $1 million, rather than investing the money in that building to deliver the service, you might put that money in the bank and earn 5%, which is $50,000 income. So you're foregoing a value of $50,000. For someone to come and duplicate your service, they're going to either have to rent and pay $50,000 rent, say, or buy an equivalent building for $1 million and pay $50,000 in interest. So it's worth understanding the capital value tied up in a business in working out the total value that you're offering to deliver that service. Does that make sense? I hope so. So that's costs. Now, as I said, the next step beyond costs is working out your price. And there are a number of things to think about in working out the price that you're offering, bearing in mind that when you respond now to tenders, you just tender a price, you don't actually tender a cost. So the first thing would be strategic and organisational issues that might influence your price. And that'll be things like the impact of that service that you're offering, which may enable you to do other services within the sector. So an example would be if you wanted to offer employment services, you might have a training and development arm which helps the people doing employment services prepare candidates to get jobs. And you might run that training development arm at a loss because it enables you to do other stuff where you might be able to make a profit. So there will be a link between different services provided which enable you to provide a more holistic and full set of services. Some of those might be at a loss, and that's okay, providing you bear that in the context of the whole service, because you can't run everything at a loss, obviously. In fact, you can't run everything at break even, because that also won't enable you to be sustainable. Other things, if you do charge fees, the capacity of your clients to pay is important. In the commercial world, market demand for your service and your experience and reputation may determine what price you set. But importantly, the quality of your service. If you are employing highly qualified, very experienced people, you may well be able to charge a higher price than if you just employ, but if you employ graduates without a lot of experience. Okay, does that make sense? The next thing is costs. Now, obviously, when you're working out your price, costs are critical, and you do need to generally recover your costs. There will be, as I said before, there will be times when you might not, but overwhelmingly you will. You certainly want to, if you didn't recover your costs, you want to have a very good reason for not doing it. So understand your costs are important, and particularly that overhead component. You need to think about the value of notional costs. You need also to think about whether or not you can leverage off donation type income. If you have a fundraising arm because the service you're providing is highly regarded by the community, it may be feasible that you can do it for a lower price because you do have access to donation income. However, as Paul said, that's not an excuse for not getting full funding. It's just something to think about. And it's also important to think about cash flow issues. Something might be profitable, but if you don't have the cash flow to meet the costs they fall due, then you won't be able to sustain the business. The next thing is to build in a margin beyond your costs. So the third thing in determining your price is working out how much of a margin do you put onto your costs, bearing in mind the strategic type issues that your organisation is facing. Building in a margin beyond that cost. And what do you need a margin for? Well, the first thing is margin for risk. It is a fact that things don't always go according to plan. Things go wrong. and it's important that you do have some sort of margin there build up over time to enable the business to deal with issues as they arise. This is an integral part of the policy where it's recognised that for an organisation to be sustainable, it needs to be able to deal with operational risk. Now, there's no fixed amount or standard amount of how much that risk margin should be, but it does depend on the extent of the risk. So the higher the risk, so higher in terms of likelihood of something going wrong, or higher in terms of the cost of something going wrong, then the more margin you need to build into your price to cover that risk. Now, there's different ways of doing it, but for a start, it's just working out what might go wrong and how would you deal with it and how much would you need to deal with that. So it might be that you determine that you need $50,000 in the bank to enable you to get through something that you think might happen. So $50,000 might be more than your program could manage in year one, depending on the size of it, of course. And it might be that over a 3 or 4 year or 5 year period, you put aside a certain amount each year into this fund, which you might just call risk. Sometimes it's called uncommitted funds, and often it's got a different name, and different organisations already do it. It's just understanding what it's for and why you're doing it, and how you actually get that fund going by having a margin. Second thing is innovation. Again, the contract requires that that agencies be innovative and work collaboratively with government in developing new services. Within a normal management team and management setup, there is already space there for innovation. So it's an expectation that CEOs and others think about the service they're delivering, as Paul said, and assess how effectively they're achieving their outcomes and perhaps come up with new ways of doing it. And that will be in your costs already. However, the reality is that when you do start a new service, there's new costs attached to that. There's time spent running around getting licences, maybe getting a consultant to assess its viability, maybe getting accommodation organised. And then even when you get a service up and going, there might be a period of time where it's not going to be viable as the service becomes established and your clients, you build a client base, if you do have a fee for service. So that cost comes up before you actually deliver the service. Therefore, you need some sort of capacity to think about how you're going to do that. In the commercial world, things like venture capital and startup capital and seed capital type words are used. That's to describe the fact that you need money to do it. So if you do build in a margin with your existing services to enable to do new stuff, then that allows you to do it. Quite often you hear, if only we had the money to get it going. I'm suggesting that that's a good plan to build that into your cost, to build that margin up now. Thirdly, capital investment. In the for-profit world, there's various ways of getting capital for capital investment. You could go to your shareholders and raise capital that way, and you can go to your bank and raise capital through borrowings. And you can do the borrowings thing as a not-for-profit as well. However, it's not always feasible. So generally the main sources of funding for capital in the not-for-profit sector is either a grant, obtaining a grant from Lottery West or the like, or the government agency that's funding your service, or borrowing. That does happen, but sometimes smaller not-for-profits don't have the capacity to borrow. Or thirdly, through organic growth. In other words, establishing some sort of margin in your services that enables you to build up a base for capital investment. And it doesn't have to be a lot, because quite often when you do seek grants, if you can prove up or make a contribution to a grant, it may be that the funding agency will look more favourably towards you. So if you want to buy a new bus, say, the bus costs $70,000, and you have a budget which is pretty tight, but if you can just put aside, say, $10,000 a year from the margin you make towards a capital fund, that will build up over time, but even if you don't get the $70,000, the fact you can build it up, say, to $20,000 puts you in a much stronger place to go and seek funding from an agency that's available to make those sort of grants. And finally, there's what I will call a social dividend, where not-for-profit agencies, because of the type of groups they do, often do services for no cost, which there's no funding at all, but because they see a real need to do it. Now, in the financial world, if you look at a company that might have 1 million shares, if it makes $10 million worth of profit, if you look at the financial statements, you'd see earnings per share of $10 per share. You might also see a dividend they pay, and the dividend might be, say, $4 a share, which leaves $6. Now, that $4 a share dividend is obviously the dividend to the shareholders, the people that own the business. For not-for-profits, that $4, the equivalent $4, might be to deliver services that are really required and not funded elsewhere. The other $6 that the companies retain is really the money that they retain for risk and for capital and innovation, those sorts of things. So it's a parallel type consideration. It's just that there's no dividend to shareholders, there's a dividend by providing services that aren't otherwise met. Does that make sense? However, it's great to think about all these costs and all these contingencies. The reality is that sometimes you're faced with a fixed term contract, a fixed price contract, sorry, where there's only a certain amount of money available to you. Now, funding agencies also have budgets, and sometimes that's just the reality of the world. There's not additional funding. And they also have accountabilities for service, so they are expected to deliver levels of service within a price. So that may well flow on to not-for-profit agencies facing that reality. So what do you do? What do you do if you've worked out what your costs are, taken into account those contingencies, built in a margin, but the price is not, the price of, or the money available is not going to match what you believe those costs to be. And that you've probably all experienced that, and that probably will happen in the future. So there's a couple of things you can do. And the preferable thing to do is to change the level of outcomes. In other words, manage the volume of work that you do so that you're being properly reimbursed for the level of work that's being undertaken. Now, if that's possible, that's, I believe, the most likely outcome to ensure your future sustainability. If that's not possible, then you look at your service model. Going back to the graph where we're talking about activities and outcomes, you look at your activities and decide, are the way that we're doing these activities are there other ways we could do it at a lower cost to deliver the same outcomes? So going back to that example of counselling for prisoners, this might be quite unrealistic, but rather than sending someone out to the prison to do it, maybe you can think about doing it by teleconference and save the travel time. If that sort of concept needs to be thought about. The other way is adjusting your service model for quality. So again, rather than having 5-year trained graduates with master's degrees, you might have 1-year trained people, acknowledging the fact that the quality of the service may not be as good, and that's a reality, but providing it still can largely deliver the outcomes that are required, it might be that you can do it at a lower price. The next thing you could do is adjust your margin. Talked before about having margins for the different things. It might be that if you particularly need to do a service, maybe to support other services or because philosophically that's what you do, it might be that you would agree to charge, not include such a big margin for various services. Now, however, if you do that, you do it with your eyes wide open, knowing the long-term consequences of doing that widely. It's almost one of those things you perhaps do for a small part of the business, and there are times when that happens, but if you adopt that policy for everything, then again you really threaten your sustainability over time. The next thing you can do is think about supplementary fees. It's always feasible to have supplementary fees or fees for your clients, but if it is possible, then you need to think about it. And alternatively, you might think about alternative sources of income. Maybe see if there's other fundraising that you can do, or other funders that are prepared to complement what you're getting from the contract you're applying for. In the past, as Paul said, often having alternative sources of income worked against you in your contracting. Now it's sort of saying it's really good if you can do that, because the more you can leverage it's not for profit, the more viable your service might become. And finally, you can elect not to do it, and sometimes that's going to happen, where a service just will not be viable for you to do because the reimbursement won't provide for future sustainability. Other matters. First one is just to be aware of the Charities Commission and its reporting obligations. And there's a very good, they have a very good website. If you just Google Charities Commission, the details are all there. And also preparing for consumer-directed care, which is where funding goes to clients or the end users to go and select the service provider to deliver the services. That may well have implications for some areas of the not-for-profit sector and fundamentally change the way they structure their services. The other thing that I didn't mention before when thinking about future costs, I've just thought about it, is building in the cost of establishing data systems and quality systems to evaluate your outcomes. Because again, it's your value proposition that you're offering, and the more you can prove the viability of your activities to deliver the outcome and the value inherent in your services because of the costs, the proof that you've thought through your costs, and those costs will enable you to provide a sustainable future and provide discounts or recognition of volunteers and other notional costs, the stronger the case.